So the question is, what is rebalancing and why is it important? First of all, rebalancing is a pretty simple concept that when you diversify your assets into different asset classes, rebalancing means basically you've set a target. This is what I'm comfortable with. For example, to simplify it, you could say, well, I'm comfortable with 50% of my assets in stocks and 50% in bonds. And this goes way deeper and broader than that. But for illustration purposes, that's my comfort level. That's suitable. It's appropriate for my investment style or my risk profile. Rebalancing just means that if you implement that and you wake up in a year and equities have gone up quite a bit, and now you're at 55% equities and 45% fixed income, rebalancing means you peel back the equities by 5% to get back to your 50-50 target. The ironic thing about rebalancing is usually in that moment, it's not what we want to do because we see things that are doing well and we assume things are always going to do well. So what most people want to do is they want to say, well, stocks are doing really well, so I know we're up to 55%, but now we're going to move to 60% or 70% because that's where I'm making my money. That's the opposite of rebalancing. Rebalancing forces you to sell assets when they've gone up and buy assets when they've gone down. So it's important because there's an emotional, psychological component to this. Dalbar, a lot of people have done these studies, but they do studies on behavioral finance. And what the average investor does is they chase returns. They look at where is money being made, where have I made the most money, and I want to put more money into that. We don't believe that's the way to approach it. Rebalancing forces you to say, well, things don't go up forever, they don't go down forever. So instead of chasing returns and buying what's doing well, it makes more sense historically, mathematically, and logically to go, I'm going to peel back on some of what I've made the most money is in, because this train doesn't go on forever. So it's important as much for our behavior and emotion and psychology. And it doesn't mean you never change your risk profile when it comes to investing, but the reasons to change it are not based on what we tend to want to do, which is, let me go figure out what has made the most money and put more money into it.